Hello, my name is Tarek Elyafi, and I'm with Standard Chartered Bank. I run the Standard Chartered Cash Management Sales team. And today we're going to talk to you about the impact of rising interest rates. We've all seen the first rate hike of the year in middle of March that's coming through, and we expect a lot more in the remaining year in 2022. So we thought we would have a group to talk about the implications of this to cash management, to working capital. We have a couple of speakers with us today. The first is Saad Hachimy, who is a risk manager, group treasury at Netsle. And also joining us today is Bob Stark, who is the group head of market strategy at Kyriba. Saad is joining us today from Switzerland, and Bob is joining us today from Vancouver. Welcome, Saad and Bob.
Thank you, Tarek. Thanks.
Great. So I'm going to dive right in. Obviously, the topic is interest rates. We have seen Standard Chartered clients start to react in some way, paying down debt. And they've told us that they have some plans to potentially repatriate cash back to the U.S. Now that interest rates are higher. There's some plans for DCM activity potentially, and obviously they're looking to make some of their structures more efficient. But maybe Saad, I'm going to turn to you. Maybe from your perspective, how do you see this impacting big multinationals? And in 2022, what do you think the implications will be on cash management?
That's a good question, Tarek. So the thing is, the basic theory says that when interest rates go higher, then the funds are more expensive to source and to leverage cash. Now, what I believe that's a fact, and as you mentioned, that's mainly driven, I think, now for all the inflationary pressure that the markets are surfing, and maybe all the multinationals that are going with it. I think it's something that we cannot unfortunately change, and it has been announced already that we are expecting quite many hikes in that sense. But I think as all multinationals, they are trying to optimize as much as they can the cash management, and it's in that sense. Then I think they're putting a bit more pressure on the cash flow forecast. I think on the payments, on the collections, and this is the only thing. Well, one of the only things I would believe can help optimize the cost of the financial cost that all these multinationals might have. And then at the end of the day, I think any of them have different, let's say, leverage with money lenders, and financial actors of the market. So I see it quite challenging, to be honest, for the next months, and mainly with all what's happening around. But I think it's something that we cannot hide from, and it's something that we are going to in any case. So I think at the end, as I said, is to optimize the internal procedures, which every one of us has the hands on, and then try to manage the external variables as best as we can.
Yeah, thank you, Saad. And obviously, by external variables, we're sitting here at the end of March, and we're also dealing with a major war that's happening in Europe, and that is obviously also impacting, how our clients are behaving or will behave at the end of the year. So, Bob, I'd like to move to you. Same question to you. I'd like to get your perspective as well on the same topic.
Yeah, absolutely. And I really excited to answer about cash forecasting, because that is a key component in this. There's a normal answer. Normally, when we see interest rates go up, we try and reduce our interest expense. We try and increase the opportunity to capture yield through investments and unlocking idle cash. But right now in 2022, things are a little bit different. And over the past 2 years, we've had this search and need for liquidity. So traditionally, we would see debt goes down, and we would just focus on different levers to ensure that we have cash and liquidity. But that's not necessarily happening right now because of all the risk aversion and decisions that have been made over the past several years. So what we see is that there's this need to understand our liquidity. And that's why I like that cash forecasting answer, because that cash and liquidity forecast becomes pivotal to understand what is our cost of liquidity and what can we do to make sure that it doesn't cost us significantly more. which means perhaps looking at different ways to raise cash. It also means that search for yield becomes that much more important. So there's an efficiency to be able to understand on a daily basis for operational cash, what can I unlock and use less of? How can I use less of my cash for working capital and divert more to something that earns yield? And then being able to create more non-operational cash that could be invested in different ways, again, to create yield so that we reduce the pressure on our cost of liquidity.
Thanks for that, Bob. And actually, really related to that point you just made, is there a need to diversify the cash funding profile in response to rising interest rate environment and consider other assets and tools like receivables financing, commercial paper, issuance, letters of credit? So what are your thoughts on that?
Yes, yes, and yes to each of those things that you said around different funding options. The levers that are at the treasurer's disposal are really quite advanced compared to what we've seen in the past decade. So you mentioned a couple of examples. Receivables financing is one that's shown some interest in many treasury organizations simply because it actually pulls a lever that typically treasury was not having as an option at their disposal. We've seen a lot of treasury groups, especially European-based, that have focused on things like supplier financing, payables financing, but being able to flip it and understand how can we actually focus on improving DSO is a very strategic function, and it's a great opportunity to raise cash. And as I said, that cost of liquidity basically decrease that cost of liquidity. Commercial paper issuance, letters of credit, if you do those things well, then it's a more efficient way to raise cash, perhaps than compared to looking at your revolver line of credit, those traditional means that are a bit more expensive. And as you know, they're rising in cost. So what we see right now in the early part of 2022, we're going to see a very different interest rate profile towards the end. And those traditional means are becoming that much more expensive, which means that search for efficient raising of liquidity and cash is becoming that much more important.
Great. Thanks, Bob. And so Saad, obviously, and Bob mentioned some of this, in a rising interest rate environment, there is more pressure to find efficient ways to unlock cash. And we talked about some of the financing structures. What about for you? Do you see this happening in the marketplace?
Definitely. Honestly, I join on what and highlight even what Bob said. I think those means were already there. I mean, all multinationals were using them already. I mean, all these supply finance, as we say, the cash sourcing of low interest rate getting from different places, receivable selling and these kind of aspects. This was there, and commercial papers and all this situation. But I think as of now, it got more accentuated, let's say, and it got also more tricky to use, because at the end of the day, I think the interest rates are getting higher for everyone, and everyone is looking to optimize that cost. So when we look at it from a supplier financing perspective, or whether it is receivable selling, or whether it is with any financial counterpart, so I think from their side is the same. I believe also that there is a risk profiling here also when in terms of the cash sourcing, right? I think the leverage that a multinational that has a very good credit rate will have a better leverage on getting cheaper cash than other ones. But definitely, all these sources that Bob mentioned and yourself, they are on the table, and they are being looked at on almost a daily basis, not to say, yeah. So.
No, I appreciate that. And I think, so the next question, so obviously during COVID, the name of the game around cash management was flexibility. Clients were going very short term on their cash, and now we also have a war to deal with, and so uncertainty seems to be the new norm around what's needed and what's going to happen next. So at least what we see with our clients is there's a strong desire to say short term on their cash, as opposed to lock it away in longer term structures and still rely on heavy liquidity on the balance sheet. Bob, let me ask you the question: Do you agree with that? Do you believe that companies will remain long on cash, keep it liquid, or do you think anything will change as opposed to, and again, we're not out of the woods with COVID as well. So I just want to see what your thoughts are.
Yeah, no, it's a great question. And I think that the background of, we came out of 2 years of understanding there's a lot of different uncertainty. That's what we learned. We learned, as you say, the new normal was uncertainty. So we've been trained over the last 2 years to deal with what this volatility is bringing right now. That said, we've also seen fairly resilient growth in all parts of the world, certainly in the United States and in Western Europe. We've seen a lot of that. And so I think what we're seeing right now and in the first half of 2022 is a continuation of that trend. Hold liquidity, hold cash, and basically make sure the balance sheet is resilient to whatever may come. That said, there's a possibility, as we see, presuming that we see continued growth in corporates and multinationals, we may see that behavior change as interest rates continue to move up. The shape of the yield curve, not just the fact that it's rising, but the shape of the yield curve will dictate where those opportunities come. But there's a lot of organizations that feel like they've weathered the worst storm in terms of the pandemic over the past 2 years, and feel perhaps there's opportunities to look for higher yield in slightly different options than, say, just your basic cash equivalents.
Great, Bob. And Saad, as risk manager, I'm sure you look at this very closely. What are your views around managing the risk situation?
I think the new reality is the uncertainty, as Bob said. Honestly, I couldn't summarize it better. And well, I don't know if to say, but the positive thing of our job is that not they look the same. So when you wake up in the morning, then you open your laptop and let's see what the day brings. Honestly, I think it's a moment where you have many trends, and in fact, you can just when you check the news and when you read what the analyst says and what the financial entities are doing outside in the market, you see really opposite ideas being in place and being discussed. I think it's a moment of as I used to say, brace yourself and sit on the chair, and turbulences are coming, right? So just the idea is to optimize, to make sure you manage your risk properly, to make sure that your risk variables are on the green side at least, or you are not risking more than what you can afford. And obviously, at the end of the day, as you mentioned, we don't only have the financial risks, so we are also seeing operational risks really everywhere, right? So at the end of the day, okay, what you mentioned, the war in Ukraine, but that's a deal breaker. But the war in Ukraine just changed the focus to the war of Ukraine, while the other issues are still there. When we say, for instance, the inflationary situation in Africa, and then the Middle East, and all these aspects are still there that we have to manage on a daily basis. So I think at the end of the day is really just to try to optimize as much as you can, try to leverage your situation and your probabilities, and make the most out of your let's say leverage in the market. In every aspect of the risk management, be it financial, be it operational. So I think that's the difficulty now.
No, thank you, Saad. I think that that actually, I'm sure, rings true to many of our clients as well. So drawing on the last question, drawing on the divergence between the Fed's FOMC actions and the rest of the world's major central banks like the BOE, the BOJ, ECB, etc., will there be regional trends? So Saad, maybe I'm going to ask you that question. How are you addressing some of the divergence, and are you seeing some of these regional trends as well?
Personally, I would say before the conflict in Europe, honestly, I was seeing all the markets following up, all the central banks, because at the end of the day, the inflationary situation is out of our hands in almost every single country. I was reading the other day that, for instance, North African countries with the lack of rain and their dependence on agriculture and the raw materials was getting the inflation on the skies, and then many even south let's say sub-Saharan countries, and then the Middle East. So I was really confident that giving that and the dependency on the USD, main central banks will have to follow and look at increasing some interest rates. Now, with the current situation and the current, let's say, impact of the situation in Europe, I'm not sure anymore, to be honest. I'm not sure anymore, because I think they would have all need to balance between fighting inflation and fighting the crisis and fighting the oil pressure, the gas pressure. So yeah, I think honestly it's all linked at the end of the day, I think, to the risk management side. And I do believe that it's a moment of wait and see, and take decisions as they come, to either take advantage of the situation, or just at least to mitigate a deeper crisis, let's say. But I think it's really difficult to anticipate what's gonna happen. Before, maybe it was slightly clearer, because we were thinking we are going out of the crisis, then the rates will get higher, and the world will get better. But unfortunately, that's not the case, and I believe that this year wouldn't be easy, at least from a financial risk management perspective.
Thanks, Saad. And Bob, anything additional to add to that?
Yeah, I really like that answer that Saad offered, because we see the same thing. Is that obviously these actions are very reactionary. They're looking at just curbing inflation. They're looking at trying to do the minimum to ensure the economies stay on track. And so it's not a matter of if, it's a matter of when. And that timing is going to be a little bit different in each region. So as an example, what we see in the US, we may see some further hikes that happen a little bit more quickly than perhaps some other parts of the world. And if that's the way we see it, then we're going to see not just potential mobility issues in terms of cash, like chasing yield, but also we're going to see changes in currency rates. And then suddenly that presents a new issue for Saad and other multinationals that are trying to understand, how do we protect the balance sheet and how do we protect the income statements and cash flow from currency volatility, in addition to all the other factors that we just spoke about. And it really comes down to understanding what your risk exposures are to currency, to interest rate, even to inflation, modeling those liquidity scenarios, and then being in a position to quantify that vulnerability so you can make decisions, whether it's just to provide guidance to leadership or potentially take action and make some different choices.
That's great. And I think, if I can take the opportunity, I think from a bank's perspective, what Standard Chartered is saying, the main implication of raising interest rate, in addition to what we just discussed today, is that they're looking at ways to unlock cash from their own operations. So there's a lot more focus on efficiency. We've seen a lot of projects kicked off around digitalization, and around liquidity, improving the efficiency around liquidity structures. So taking idle cash from certain accounts that maybe just sitting there and putting that cash to use. The value of the dollar has gotten more expensive. It'll continue to get more expensive, and so we're seeing a lot more activity around capturing that dollar from your own operations. So we'll see a lot more of those projects kick off. We did not see as much of that in the last couple of years, but we're certainly beginning to see that. Let me take this opportunity to thank you, Saad and Bob, for a great discussion, and I appreciate. Hopefully, our viewers got a lot out of this. Thank you so much.
Thank you very much, Tarek. Thank you, Bob.
Thank you, Tarek. Thank you, Saad. Great conversation.
Okay. Thank you.